The scripture says, keep the solemnities of eternity on your mind. So if we always remember, we want to live in a state of never-ending happiness. So that should encourage us to kind of do the things we should. Okay. Today we're starting our investing side. We've done something different this semester. We've created a document. It's a pretty long document. Sorry, it's 60 pages. But it goes in detail on each of the topics that we talk about today. I haven't found a decent place that talks about investing. There's lots of people that talk about different things. There's everybody who's chasing crypto right now, and before that they were chasing gold, and before that they were chasing real estate. Before that they were chasing emerging markets. Investing isn't changing what we used to call the flavor of the month. Investing is investing long term. So your money grows and grows wisely. So let's talk a little bit of our investment plan. It includes, what are your risk and return objectives? So how much do you expect to make on your investments? What are your investing guidelines and constraints? Sound familiar? What is your investment policy, your plans and strategy? And how will you evaluate, modify, and communicate results? So your investment plan is kind of similar to a will, at least in my case. What we've done is we've gone through a number of investment plans, or in business they're called investment policy statements. So for individuals and institutions, I worked with a nonprofit that worked with autistic children in Orem. And they asked me and a group to put together their investment plan. And it's interesting, their investment plan was about 96% of what you see here. So what we've tried to do is give you a framework that's consistent across companies. So what have we done so far? We put personal finance in perspective. We understand it's simply part of living the gospel of Jesus Christ. We talked about the importance of doctrines, principles, and applications. And too many times people go directly to application. And we talked about you're living on a budget, you know where your resources go, you're managing your cash wisely, you're protecting yourself through insurance. Now we begin on investing for the long term. People ask me, is investing easy? I say investing's not easy, but it's also not hard. Again, there's a saying that says, if you do what everyone else does, you'll get what everyone else gets. What do you think most investors do? They actually beat their benchmarks. Have you heard that term? Xander, last year you got a 16% return. Was that good or bad? Okay, but what if your asset class was large cap stocks? It was up 27%. So you were only up 16%. So the only way you can know whether it's good or bad is if you compare it to benchmarks. And the problem is most people don't.
So we're going to show you how to compare what you're investing in to the benchmarks.
And it's not getting distracted by the noise. What's the noise in investing? What do you see on social media? In the newspapers? Is it crypto? Yeah, crypto's the big noise. What do you think it was last year? Crypto too, but before that it was gold. Before then it was real estate. It's funny. There's always a flavor of the month because people are always chasing last year's best performers. Is that the way you should invest? Do you invest in the rearview mirror? And the answer is no. So what we want is just a good long-term return after tax on your investments with less risk. I did investments in emerging markets, and one morning I woke up and there was the coup in the Philippines and our investments had all dropped by 30%. I woke up and another morning there was foreign exchange controls in Malaysia and we had 50 million in Malaysia that we couldn't get out. So I've woken up lots of mornings with things that really weren't much fun. And we've decided that what we want to do is build what we call a sleep well portfolio. That no matter what happens, we're well. And so that's what we want. What about, some of you are saying, well, wait a second, my country doesn't have a lot of these things too. So although we'll be discussing the US market, realize the principles apply everywhere. So your goal is to apply the principles within the financial system that's available to you, to the opportunities within your country. So, but wherever you live, the goal is to build financial security over time. To what do we want to do? We want to accomplish our personal and family financial vision and goals, because that's what we want. So what are we going to talk about today? Again, we've got 10 steps to better investing. We spend a lot of time talking with people and coming up with these things. Notice, what are the things we'll talk about? Principles, asset classes, investment vehicles, mutual funds, risk tolerance, asset allocation, investment strategy.
But this isn't all the stuff we're going to talk about today.
No,
this is the stuff we're going to talk about the first two today.
Yeah. And that's what we'll talk about over the next 5 days. A lot of times people want to invest, but they're not even living on a budget. They're not saving money. You can't invest, well, you can invest with borrowed money, but it's extremely risky. It's not recommended. We've put together what we call the investment hourglass to help us as we teach investing. We're going to talk about the top of the investment hourglass today, and then on we'll talk about the bottom of the investment hourglass. But this is what it looks. It's a series of 4 questions to ask. And if you can answer yes to these, then you're ready to invest. Number 1, are your priorities in order? And are you square with the Lord? It makes no sense to invest when you haven't paid your most important creditor. Number 2, do you have adequate health and life insurance? Most of you are single, you don't need life insurance. And you have BYH health insurance, so you're good here. Are you out of high interest rate credit card and consumer debt? Again, does it make sense to invest when you're paying 28 and 29% on your credit cards or consumer loans? And then the last one, have you written your personal and family vision and goals? Do you live on a budget? And do you have a well-written plan? This is called the Serenity Prayer. We had this Precious Moments figurine. It was sitting on our mantelpiece in our bedroom for years. We just liked it. Actually, Sister Sudwick's liked it.
It was mine.
And then I realized, hey, this can be applied to investing.
So he stole it.
I saw he stole it. So what are the factors controlling investment returns? Truthfully, there's only 5 factors controlling investment returns. So how much you save and invest, how long your investment grows, your risk level, how much you pay in expenses, how much you pay in taxes.
Those are the things you can control.
What are the things you can't control?
Yeah. There's one thing you can't control. What is it?
Yeah.
Returns.
Yeah, you can't control investment returns.
Yep.
And I can always tell the experienced investors is they work on the things they can control and don't worry about the things they can't control.
Here, I'll push it.
This is a group called Dalbar. Every year they put out what's called the quantitative analysis of investor behavior. They go into these brokerage houses and then they get all the results. And then they actually calculate, how did these guys, not what they say they did, but how did they actually do? So over the time period from 2003 to 2022, the average equity investor returned 9%. The index was up 9.8%.
So that means that they underperformed by 0.8%.
And that's not minus 0.08 for 20 years. That's minus 0.08 a year for 20 years. Okay, let's go. What about bond investors? Maybe it's just the equity investors aren't doing very good. How about bond investors? Notice the average bond investor was off minus 0.3. Benchmark was up 3.1. They underperformed by 3.4%.
That was even more.
Someone said, you do what everyone else does, you'll get what everyone else gets. How about actively managed funds? So before, my partner and I ran a no-load mutual fund that did investments in emerging markets. So people paid us well. We flew business class. We stayed in 5-star hotels. 3 to 4 times a year, I'd hop on a plane and I'd go either to Asia, Middle East, Africa, visiting companies. Do actively managed funds, they charge you more, but do they outperform? What do you think?
Yes, somebody said yes.
So this is data. This is over the last 20 years. This is from S&P Research. It's called SPIVA. And we're waiting to get the enough for 2024. Over the last 20 years, 60% of actively managed funds have underperformed their benchmarks. So nearly 2/3.
So how can you tell from this chart that they underperformed their benchmarks?
That's the chart. This is the percent of underperform. So exactly in 2023, 85% of all equities underperformed their benchmark. And so this right here is just the average over 20 years, and this is the average over 10 years.
But basically, they underperformed.
Yeah. So the interesting thing, too, is you could buy an index funds that gives you exposure to your benchmark, and you can equal your benchmark return.